Bloomberg Audio Studios. Podcasts, radio, news. This is Masters in Business with Barry Ritholtz on Bloomberg Radio.
This week on the podcast, another extra special guest. Matt Cherwin is co-founder and chief investment officer at Marek Capital. He previously spent 16 years at JPMorgan Chase and then a bunch of years at Citigroup beforehand, running all sorts of spread markets, head of securitized product, lots of CIO and risk management titles. I came to know Marek through a live event we did at Bloomberg last year. I found that his approach to credit and trading is absolutely fascinating, and what Marek is doing is really quite interesting. I thought the conversation was brilliant, and I think you will also. With no further ado, my conversation with Marek Capital's Matt Cherwin. Matt Cherwin, welcome to Bloomberg.
Thanks for having me. This is exciting. That was a bigger windup than I was
I like
expecting.
I like a big windup because it gives us an opportunity to roll back to the beginning and say, all right, bachelor's in economics from the University of Pennsylvania. What was the original career plan? I don't imagine people going to college and saying, I want to be the head of global spread markets.
No, but that's super interesting because our oldest is a sophomore in college now. Mm-hmm. And he's in the business school at American. And I was just talking to him yesterday, and he said, I'm now in, I think they call it like finance for business. I really like this new class. And I said to him, that reminds me so well of when I was in undergrad business school, and I did the first couple semesters at econ, and I hated it. And
I had a similar experience with economics.
And it was like, you know, I shouldn't have hated it as much as I did, but at the time, it was ISLM curves, it was supply, it was demand, et cetera. And it didn't feel very practical to me. And I didn't do very well in it. I didn't go to class very often. I didn't do very well. But then we got to kind of the next semester, which I think they called Finance 101 and was like bond math, discounted cash flows. And I was like, oh, this I like. Okay, I am in the right place.
Well, it's much more realistic, and you're not dealing with homo economicus. That is this theoretical version of humans.
Looking back on, I wish I had listened a bit more at some of those others. But, something I say, maybe we'll get to, is like, it just, a recommendation I would give to other people, it took me a little while to realize what I was interested in, what I was interested in being interested in. Mm-hmm. And when I got into some of those classes, kind of the more financy kind of stuff, I was like, this I like, this makes sense. I want to learn more. And I think that's kind of where it starts. So I always wanted to I just like when there's, numbers on the page, it adds up to something, you're trying to make money, it's hopefully positive at the end, it might be negative. It's pretty clear cut, at least the goal is. And I always like that, I always gravitated towards that.
So economics, way too abstract and academic, but business and finance, practical, applicable, real life usage. Yeah,
which is interesting too, because I'm a little bit like this is a little exaggerated, but I'm a little bit of like a history buff. So like it was interesting that what didn't appeal to me, because I do like kind of the history of it. How did we get here? And I think that's always something that I'm like in this forum as well. Going back to learn more about financial systems, how money works, how they thought it used to work, different schools of thoughts. And I think it really helps you understand where you've been, where you are, where you're going.
So when you look back, when you were group treasurer or chief investment officer at the JPMorgan division you were involved in, what sort of lessons did you take away from that? You're in the real world managing real risk, real portfolios. How did that experience change how you perceive risk?
Yeah, it's a great question. And I'll tell you, so obviously I had a career with a background in trading, running trading teams, both on the buy side and the sell side. And it was really that experience that this next piece that was transformative for me and, really brought us to the point where my partner, Derek Goodman, and I decided let's form Marek. And, I'm sure we'll get into that a bit. But what happened was I spent 20 odd years trading mortgages, rates, corporate credit, high yield, products like that, working with specialty finance companies, some that I worked with, some I had a hand in running, this kind of universe. And then in late 2019, I had the opportunity to move over, and this was a different building, different, walled off key card, different team, and be the CIO and the treasurer. So this is now buy side, running the capital of the firm, the investment of the firm, hedging and managing structural risk, lots of things wrapped up in there. But the real thing was the point in time where this happened was late 2019. A few days later was the repo crisis, if we remember that, when all of a sudden, if you wanted to borrow overnight against treasuries, it cost you 10%. Right. Okay. 6 months after that, pandemic breaks out. And why I bring that up is so much changed in dramatic size at rapid speed that I saw something I'd never seen before. And it was, how does the financial system really work? And what does it mean? And how does it apply to everything that I've done? And it was one of these moments where I felt like I just went from being the captain of the ship, my own little thing, right? We'll be a little expansive with it. I went from being the captain of the ship to going to work in the engine room and seeing the actual gearing and how it works and how it doesn't and what could stop it from working. And you spend years, you pull a lever, you think the boat goes faster, but you don't know why. And you don't know what could stop it from doing that. And you don't know what could make it work more efficiently. But now you go work in the engine room and you see it and you understand it. It was just this aha moment. Like, we're two guys with glasses, right? So, when you go to you get a new prescription, you get your new glasses, you put them on, you're like, oh my God, I can see, right? And by the way, how was I walking around the streets of Manhattan with that old prescription, but now I can see clearly? And honestly, 20 odd years into my career, that's how I felt at that moment.
In 2019?
Yeah, I would say like in early 2020, about 6 months in, it was kind of like, oh my goodness, it's coming together now. I wish I had known this for the 20 years that preceded this, but I felt like now I know nothing and I'm starting to learn.
So I have to ask, my experience with 2019 was that wobble seemed to go by so quickly compared to 08, 09, where, to me, you saw a lot of warning signs, first in housing and then in securitized product and then in construction. And then, the market didn't peak till October 07. And the next 18 months were kind of fun if you were on the right side of it. But if you weren't, it must have been a bloodbath. It sounds like you derived more out of the 2019 experience than you were on a desk in 08, 09. What sort of scar tissue did that leave? How informative was that moment?
That's really interesting the way you kind of put those together. And so to set the table a bit, 07, 08, when I got to JPMorgan late 06, 07, 08, 09, I was in charge of, had a team. We traded asset-backed securities, say credit cards, auto, student loans, subprime mortgages. Remember those?
Yeah.
CLOs. So really kind of like the center of what ended up happening after that. And I would say it was so overwhelming at the time. I mean, we were there 2 a.m, hand marking bonds. Okay, walking across the street between the two buildings, like, is there more information? This company might buy that company before the market opens. What else can we do? The numbers were huge. It was almost like a bit more than you could process at the time. But I think each one of these became, every step there was like, I understand what I'm doing better now, because the first thing I ever did was I started as a cash flow structure. Mm-hmm. And actually, at that point in time, the guy who ran the department was a friend of mine named Bruce Richards, who went on to start Marathon and has had a fantastic career, and we keep in touch. And I said, I want to be a trader. And he said, well, I want you to be a structure. Because if you learn how the cash flow works, how the structure works, then you'll be a better trader. Later on, I think each piece helped me understand the risk better, and then the system it sits in, and that helps you understand the risk better. And then when you understand the risk better, you understand the system it sits in better, and it builds on top of each other. So I would say in 08, I learned more. In 08, we felt like we were the tip of the spear in like a bad way. And we could see it was getting worse and it was accelerating. And we could see that people were maybe even underestimating. And I remember some conversations around at the time that we were basically saying, like, think bigger, think broader, think worse. That's the context we're talking about. But all of that helped me understand, how does my product I'm trading fit into an investment bank? How does an investment bank impact the system? I think when I went into 2019, obviously time had passed, I'd had more experiences, et cetera. I remember sitting in a meeting. We're in 7:30 a.m. traders meeting. This is with the CIO group. And we go around the table, my rates lead, my credit lead, et cetera. And the repo guys walk in and they say, hey, we can lend against treasuries at 10%. Should we do more? And I said, guys, this is my third day with this team, okay? I'm the person in the room who knows the least about what you're talking about. But if you need my authorization, you have it, because that sounds pretty great.
10% yield against with
that
treasuries?
That sounds fantastic. My response to you is, how much can we, not can we do more, like how much can we do, meaning more and more. And that just became the beginning of, like, why did that happen? How did we get here? Where did it come from? Where does it go? And I found that certain people knew certain pieces, but not the picture. And then you're like, it was just starting to pull at it.
And that was your job, to know the whole picture.
It became the focus of what I wanted to know, because unpacking that would help me understand, how do we get here? Why does this happen? And by the way, what are the pieces that put this all together? And how do we take advantage of that? How do we protect ourselves? But also, how do we take advantage of that? So it was the whole thing was this one of those types of things you say, I opened up a door, 3 doors behind it, and I want to keep going that direction. And it felt to me like a purer and purer version of everything I'd done in my career, getting closer and closer to the source and pricing. Really,
really fascinating. One of the things I think a lot of people don't realize about JPMorgan Chase during the financial crisis, and I never, doing the research for Bailout Nation, I never got this really sourced the way I would have liked to, but JPMorgan Chase had their own derivative scare a couple of years earlier, and the word was, Jamie just said, clear all this junk off of our balance sheet. We can't handle this. Risk doesn't seem to be worth the potential upside. So heading into 08, 09, they weren't dealing with the same sort of existential danger that Merrill Lynch and Wells Fargo and go down the list all had to go through. They ended up being an acquirer of distressed assets, not a seller of distressed assets.
Well, I mean, it was a tremendous place to work. I worked with incredible people. I learned a lot. And I worked with great, great people that you're just part of a terrific team. It's a fantastic place. I learned something that became transformative to everything I'd spent my career doing. So that's why we set out to, and I said, I want to do this. And that's why we set out to build Marek. When we said, I recall Derek and I sat down one day and I said, here's how I think about markets. I think about it in terms of money, capital, credit, liquidity, and regulation. That's my 5. Money, capital, credit, liquidity, regulation. MCCLR.
How do you separate money from capital?
So I think money to me is, how do you make it? How do you destroy it? How does it move through the system? To me, capital is a little bit more of, how much do you have? How do you measure it? How much do you have? Are you making more? Are you destroying it? Credit is really, how is it being formed? How is it moving through the system? The financial system is changing now. Mm-hmm. It's very different than it was a few years ago. We actually, when we were, really trying to get our ideas on paper, we wrote a paper that we outlined saying, we described what we thought was the new version of the financial system. We said the financial system is changing. You're de facto recreating Glass-Steagall. You have GSIBs, if you come from some of this framework, are the globally systematically important banks, systemically important banks. Think JPMorgan, Wells, Bank of America, et cetera. We said they're the new GSIBs. People like Apollo, Blackstone, KKR, BlackRock. These are Ares. These are the folks that are actually making credit extension decisions in this economy. Okay, you have the traders like Citadel Securities, Jump, Jane, some of these other names everybody's familiar with. This is disaggregating the financial system and putting it into different buckets. So basically, we think about where's it coming from? Where does it go? Who wins? Who loses? What are the flywheels here? This is a process that we apply to everything we do. Some of the guys on the team call it MCLR, MCCLR. It's the lens that we look at because we believe money, capital, credit, liquidity, and regulation drives economies, markets, and prices. And then you can really start to understand monetary policy, real estate, housing, the types of specialty finance companies we've talked about, consumer. So this, to me, actually explains how it all works, and we apply that. It's a huge addressable universe. We trade rates, mortgages, securitized products, corporate credit, related equities. It's an enormous addressable universe with investors that have very narrow mandates that transact at different points in time, and sometimes non-economically and bound by potentially non-economic rules, which means there are a lot of overlaps that people don't take the advantage of, and there's a lot of gaps that they quite simply don't bridge. And the setup for all of this, I think, and I've seen some stuff, a lot of your listeners have seen quite a bunch of stuff. We've seen things go right. We've seen things go wrong. This is one of the best setups we've seen in a long time. And so that's why we went out to say, I saw some interesting stuff. I learned some interesting stuff. There's an opportunity set that we want to prosecute right now, and it is an incredible time to do so. So we built a team. Sorry, go ahead.
I was just going to, no, I'm fascinated. Yeah. I want to roll back to something you said earlier, which was Glass-Steagall is sort of being backdoor reapplied. Is that a function of people being risk averse, or is that a function of people just specializing in their own silo? So you don't have, Glass-Steagall, for people who aren't economic and policy wonks, separated the FDIC safe banks from the riskier investment banks. And once that was repealed in the late 90s, didn't cause the financial crisis, but allowed all these banks to merge and get bigger, and maybe it made the crisis a little worse. But I don't think of it as the underlying cause. But the idea that the market is working its way back towards that is kind of fascinating.
Right,
Address that.
Right, as you laid out, like Glass-Steagall, to oversimplify, basically said, like, you can hold deposits, you can underwrite securities, you can trade securities, things like that. And there were rules. Right now, there are like some rules that say what you can and can't do, but really there's a lot more that has morphed into what people like to call private credit, or we're going to extend credit through these fashions, or some of the rules don't apply to this group, so we can trade the markets differently, or we can make markets in a way that maybe the big banks can't. And then the big banks say, well, we're viewed as super safe, because I would argue we are, and that has its advantages also. So it's like recreated these artificial boundaries. What is great for us and the way we look at the world is we saw that, we see that, we understand that. We also see and understand and think about all day long and put it into our portfolio construction and the risk that we build. It's all up for grabs again, right? So we've got Kevin Warsh nominated to be the Fed chair, and Mickey Bowman is the vice chair for supervision, and they are I don't know what the right adjective for it is, but they're changing the rules and they're pulling some of them down. And in my opinion, people just don't understand which of them matter and which of them don't. And the market moves to place on some that simply don't matter, like its lack of understanding of what SLR was and how that worked. And we don't need to dive into that. But to simplify, they said, we're going to remove this rule and it's a big deal. And we at Marek said, you can take it off. It doesn't matter. So everything the market's doing in reaction to that is a potential opportunity for us.
In other words, people are overreacting to a regulatory change that is insignificant long term.
In that example, yeah.
Coming up, we continue our conversation with Matt Cherwin, co-founder and chief investment officer at Marek Capital, discussing why he launched the firm in 2024. I'm Barry Ritholtz. You're listening to Masters in Business on Bloomberg Radio. I'm Barry Ritholtz. You're listening to Masters in Business on Bloomberg Radio. My extra special guest today is Matt Cherwin. He is co-founder and chief investment officer of Marek Capital, specializing in a variety of alternative credit and related private products. Previously, he spent 16 years at JPMorgan Chase, where he had a number of very important titles. Before that, Citigroup. Are we in all that unique a period of time? Is the opportunity set that much greater than what we typically see in the normal, this is a little more geopolitically volatile administration than even the previous Trump administration. Is that a driver, or is it the deregulation and misapprehension of what these rule changes mean?
I think it's a combination of what's going on. So we just kind of use some little catchphrases among the team that help us sort of gravitate around concepts or communicate quickly. We say this is an administration that's in the business of being in business. Mm-hmm. And that's just there's no opinion or judgment one way or the other. It's just a statement. What this environment is also, we also came up with something that we thought was just made us chuckle one. It's important to have a little bit of sense of humor. We found our investors actually do read the materials very closely, and they tend to have a sense of humor, which is good. But we created this thing we called the One Big Beautiful Chart. Uh-huh. And we just said, what they really need, they need rates to get down, and they need it to come down a lot more than what the market and the curve has already priced in, because of how much debt the country has, what it costs, what they want to accomplish. So here's what they need to accomplish, and they're going to do everything they can to. So, we construct portfolio. We have an investment thesis. We have a narrative. Everything we put in the book has to fit that narrative, has to contribute to what we're trying to achieve, has to be the best version of that, or it has to protect us from what could go wrong. So getting back to your question a little bit, we think it's a very business-forward environment, business-forward administration. We think that it is one that needs rates to come down. We are going to have a new Fed chair in the middle of June, and he'll say all sorts of things in the confirmation hearing, but really it will be a catalyst potentially for change in the middle of the year. And then we have a bias within markets to strip back some of the layers of regulation. And away from whether you support that or not, I can tell you, because I've been on the other side of it, the layers of process and bureaucracy and spending your time back solving instead of what could we do better. When you change what your goal is and how you're pointed, you're going to get different results. We think that combination is spinning flywheels in the market now that, in our opinion, people they're underestimating the power of some of these flywheels.
Huh, really, really interesting. Last question before we talk a little bit about Marek. In the old days, and I was never a big believer in this, but everybody else was, there was some constraints on deficits and ongoing government debt because the bond vigilantes would punish you. The bond vigilantes seem to have disappeared, in part replaced by the stock vigilantes who any policy they don't like, they just sell off until they have their hissy fit until they get their way. And then, okay, thank you very much. And we're off to the races again. What do you think of the, 80s, 90s era bond vigilantes? Is that just ancient history? There's no discipline on deficit spending anymore? And by the way, I think deficits are not all that relevant. Look at Japan. Look at the U.S. history. We've been warned about deficits, and they haven't caused much of a problem most of this history.
Yeah, look, I love the term, and I think we've seen some of those episodes. Last year, we saw around the whatever we call Liberation Day in April. There were a couple days where treasuries and mortgages said, enough. Okay, that's it. And we're either going to have one of those days where they are giving stuff away or you got to pull back. And I think what we saw was the administration did pull back. So I think in some level, it's still there. But part of what we do at Marek and what influences our thought process is big parts of this have been really broken down. The markets are so big now that it's been broken into specific functions. Like people have a thing to do, and they do that in a narrow mandate. We have a more flexible mandate. To us, the products, they're widgets. They're tools in the toolbox for us to achieve our goals and our investment thesis and the portfolio risk and construction and diversification that we'd like to have. But the markets are hyper-specialized in very, very large markets. So you get some of those episodes where it's like, crowded trade, we got to get out. I think the question of does the administration react to the markets? Does the markets react to the administration? It's something that we've actually focused on quite a bit. We actually, we wrote another piece in June of 2025 that we called the Warshfed. And it was just about what could happen. And we sort of went through, to your point, like the concept of risk-free rate and credit spread are completely intertwined and commingled now, and they don't exist separately. So I think that's some of the concepts you're getting at. Like, is this a problem for credit? Is it a problem for rates? Are those the same thing now? One of the most interesting things, and I would just say before we get back to your question, is what was really interesting observation to us was during the last government shutdown, whatever mini version of that we're going through right now, it was almost, and the data was not forthcoming, and then vol went down. So it was this sort of like, a little bit like if we don't know, maybe nothing's happening. But what it also was a little bit to what you were saying is when things were a little less hyper-focused, they actually were a little less jumpy around small moves. And that was a big takeaway for us. It's a big thing you're going to hear from Kevin Warsh. If he ends up in the chair seat, you're going to hear a long narrative from him for his time in that seat of we need to step back from the day-to-day and the minute-by-minute information and think about the bigger picture and the trend and where we're headed and be a little more forward-looking. I think that's the kind of guidance that you will get from that chair.
Really, really interesting. So let's just start out with why you left the comfort of a big shop to have the headache of your own firm. What's the elevator pitch? What problem does Marek Capital solve that couldn't be solved at a large Wall Street bank?
Look, I think quite simply there are some things that banks can do and some things that banks can't do. There are some things that they can do and that they don't want to do. In my career, I've always been involved in these types of markets, being rates, mortgages, securitized products, corporate credit, the equities related to that around it, these types of specialty finance operating companies, and always felt that when you can apply the various lenses to these products, being the trader lens, the structurer lens, the operator lens, you understand it better and you get the gearing and the pieces. And when you learn about the financial system that it sits within, then you actually can understand but take advantage of the risk and return in a more elevated and efficient way.
I want to address that. Is it that the big firms, the bigger banks, were risk averse and didn't want to take advantage of it, where they were prohibited on a regulatory basis, or when they're just doing their macro risk assessment, hey, we'll go this far, but no further?
I think it's even simpler than that. We look at the world through our lens. We look at the world through the Marek lens of money, capital, credit, liquidity, and regulation, which drives economies, markets, and prices. That helps us understand the drivers of the capital markets that we sit within, helps us understand monetary policy, housing finance, commercial real estate finance, understand both the gearing of it. Then you can look at something and you can say, okay, I'm looking at Citigroup. I could buy it, I could sell it, I could understand what they're doing in the markets they have a footprint in, what that means for the markets. Do I want to buy that? So like, where are the flywheels? What does it spin to next? So everything we were doing was very much about what do we want to do? Because we see a very large addressable opportunity where we have a unique perspective, a defined lens, and a way of applying that to these big liquid markets that we think very strongly we can take advantage of in a way that people simply haven't had the opportunity to learn about and to understand and apply to these products with the type of flexible mandate that we have, which boiled down means we look at the world a little differently. These are big addressable markets which have dislocations, volatility, and opportunity all the time. And we can use that combination to achieve what's a very, very simple goal: improve the return a little bit while reducing the risk a little bit.
That's all anyone can ask for: better returns at lower risk. I'm kind of fascinated by the overall Marek investment philosophy. We'll get to, but let's start a little bit with structure. I think of you guys as an alt credit shop, but you also look a little bit like a multi-strat shop. Is it kind of a hybrid? Like, tell us about the structure.
We just define what we do. Okay, we are who we are. We do it the way that we do. We're running a hedge fund, which trades these products as, like I said, as tools in the toolbox, as widgets. We do it in one collaborative portfolio. So our setup, our structure, we've got an amazing team. We have specialists in rates, in mortgages, in non-agency mortgages and ABS, in credit, in CLOs. I am on the phone every day with traders and salespeople myself. We trade it as one book.
One portfolio. So it's really a multi-strat within a single expression.
It is what we think is the best expression of the trade.
Or I shouldn't call it multi-strat. It's really multi-asset. It's a variety of different credit assets all under one umbrella. Within
our lane, okay, sticking to our knitting, what we believe we know very well, what we know we have a differentiated insight into, and extracting from that. Okay, the team is phenomenal. They have a ton of buy-side and sell-side experience. They work very well together. It's very exciting to be, and additionally, doing this together, like Derek and I doing this together, putting our name on the door, like Marek is Matt and Derek.
Right.
Because we spent way too much time trying to think of what's a clever name.
They've all been taken. Good luck in New York.
Means, alpha extraction in Sanskrit or something, and Derek's wife one day was like, enough. It's Marek, Matt and Derek. Now go do some real work. And I think she said in a little bit more of a spicy way. But we were like, yeah, that could work. All right, let's do that.
I think just a little footnote, if you've ever incorporated an LLC or any other entity in New York State, every Greek and Roman god, every Babylonian god, every Cerberus, name the creature from mythology, it's either a fund or an LLC. They're all taken. It's astonishing.
But the real point I wanted to make also that I don't want to lose is this is putting our name on the door. Okay, it's our name, it's our reputation, and that really cemented it for us. That was something we really wanted. I took some time off, and which was fantastic, and I met some of the most amazing and interesting people in the world. When you're unaffiliated, people speak to you in a different way because they have no one to talk to. Okay, I sat down with the CEO of one of the world's largest pension fund, sovereign wealth funds, and I'd never met the person before. We had an hour-long conversation because he just needed to talk to someone. And I learned a lot in that. And I met some of the most interesting people in venture cap, in alts, in private equity, et cetera. And it was just more a way of learning parts of the system. But it got to the point where after my, academic wander through the wilderness, I was like, okay, you know what? Because at the time we had 3 teenagers living at home, and it was an amazing time. I used to always say, you should be able to retire in your 40s and go back to work in your 50s. Like, that's the way business should work. Obviously, that's a luxury that very few have. But I was getting to the point where I was like, okay, I feel great. I want to do this. I miss markets. I love this. I want to get back to it. And I want to do it in the way that I want to do it.
How long of a gap was that between Chase and
I took like about
Marek?
a year off. It's a riot. So in our deck, we put a little timeline of my experience and Derek's experience, and just to help people understand who hadn't met us, who we are. And at the very end, I put, this is my background, simple. I was here for 10 years. I was there for 16 years. And then we put like a little 1 year nugget on the end of the timeline that just said chillin', with no G, no G, just CHILLIN.
Right.
I don't remember.
Which is a very un-Wall Street sort of thing.
It was like our 900th version of the deck.
Right.
And we were just getting a little punchy. And we're like, it made us laugh. Okay.
Right.
You got to have a sense of humor. It made us laugh. So we're like, this is going in. Every investor brings it up. They bring it up and they love it. And you know what? To us, it's like, wow, you are reading every part of the deck.
Right.
And also, it's nice to know you have a sense of humor. But getting back to it was like
people. This is always shocking. People read the footnotes.
Oh, yeah. That's been a big learning for us. They read it. So when we were doing all this, my wife was like, yeah, why would you want to do something for anybody else? And I thought to myself, exactly. What are we going to work harder at? What are we going to make sure succeeds? The thing that we put our name on the door, our reputation, that we believe other people don't get it, that we believe is the right way to approach these markets, that we believe can extract from a setup which is one of the best that we've ever seen. So if you tick all those boxes, why would you do it for anybody else?
Really, really intriguing. So it's 2026. I'm legally obligated to ask, how do you use artificial intelligence in research, portfolio construction, or operations at Marek Capital?
Sure. I would sort of make two points. I'm an AI optimist. That's not one of my 2 points. So that doesn't count. We use it every day. We build stuff more quickly. We build our own tools and we build them more quickly than we ever could before. The guys on the team, they're building stuff at their desk in a week that would have taken a year to do somewhere else, literally. And I know because I've been in that. And then once you built it, it would have taken like 6 months to get approval to release it into your system, et cetera. This is like light speed versus what we used to do. Now, changing a little bit of how you frame that question, AI is a really, really interesting thing in financial markets as well. Okay, so I don't think we're there yet, but we're going to get to a place where people are using it for risk management. They're using it for compliance. They're using it for KYC, but put all that aside. The most interesting to me right now is we look at the AI CapEx boom and we say, here's a product that is commercial real estate with securitization technology around it. You're talking about where is it? Is it built? If not, how long is it going to take to build it? Who are the tenants? How long are the leases? What are they paying? What's it worth when it's all done? Is there residual risk like you have in an auto lease? Only some of it comes to the securitized market because it's just not that market's not big enough for it. So it comes to the corporate bond market. So that to us is like, that's the type of opportunity that piques our interest, where we say, this is something that looks like ABC and being wrapped up and put into a different market that is asking 1, 2, 3. And those are good questions, but it's really like, put it all together. Look at all the factors. What are the additional? Are you getting more structure? Are you getting less? Are you charging for the risk? Are you paying away for it? So the AI CapEx boom to us is actually like a source of very cheap risk for us to look at. And each one has a little bit of different flavor, and we're very opinionated about which ones we like.
It sounds really fascinating. It also sounds like anytime there's a novel area, the opportunity for mispricing seems to really... There's that.
We look at some of those first-time issuers. We have some things in the book. We have something called the North Star Playbook, which is what are companies and bonds that have clear missions and objectives that they can execute on that are aligned with us, with the instrument that we have, or misaligned, or that they're not able to execute. But some of it's actually not just about the novel structures. Let's look at agency mortgage-backed securities. Those have been around for a long time.
Right.
Okay, a couple weeks ago, tweet from the president, or whatever we call a post on Truth Social, 4:26 p.m. I've instructed my representatives to buy $200 billion of agency MBS. Boom, bomb in the agency mortgage-backed market. There are, 12 trillion of these things outstanding. In the agency mortgage market, it's 9 trillion, hundreds of billions of it trade every day. And that was a aftermarket post tweet.
And what do you do when that happens?
Event. So then,
are you out buying into that rise to take advantage? Are you a price taker or a price maker? What are you doing when that's happening?
It's both. We look instantly at like, what does this mean? What was our expectation now? In that instance, we expected the GSEs, who will be the ones who actually buy it, we expected the GSEs to be buyer. I think our view was a little bit at the high side or out of consensus even. Mm-hmm. We thought this is going to be a support mechanism for this market over the course of the year. Fannie and Freddie are going to buy a lot of this stuff.
Assuming they haven't already started to accumulate.
Well, they had been, and that's a great point. They had been. But buying $200 billion with like an aftermarket tweet and nobody knew, like, is it going to be 200 and then another 200? Are you going to start buying? Are you going to buy 40 tomorrow? How's this all going to work? This exceeded even our expectations, and you saw right away. I think we were positioned for that type of event. We were positioned to take advantage of some of the policy risk as opposed to get hit by some of the policy risk. You could see that there was a massive short covering rally right after that. And you could see that wasn't necessarily people's expectations and how they were set up for.
I have a mortgage-related question to this, but I'm going to save it to the next segment. Coming up, we continue our conversation with Matt Cherwin, co-founder and chief investment officer of Marek Capital, discussing credit and risk in today's markets. I'm Barry Ritholtz. You're listening to Masters in Business on Bloomberg Radio. I'm Barry Ritholtz. You're listening to Masters in Business on Bloomberg Radio. My extra special guest this week is Matt Cherwin, co-founder and chief investment officer of Marek Capital. Previously, he spent 25 or so years running credit and various types of risk at JPMorgan Chase and Citigroup. So we were talking earlier about the Trump tweet directing the GSEs to buy $200 billion worth of agency paper. You would have thought that should have sent yields plummeting and mortgage rates down, which would stimulate the housing market. I assume part of the motivation for that tweet and for that purchase. What's going on in that market, and why does it seem so difficult to drive rates lower?
Right. That's a great question. And as silly as it sounds, like $200 billion, it's just not enough.
Pocket cash, right. Walking around money.
That's one way.
I mean, in a $12 trillion market, 12 trillion, it's not even 1%.
Yeah, if you've got 35 trillion in treasuries outstanding, and it's a big number and it moves the needle. But what they really want to move it and keep it there. Like, that's a little bit of the hard part, because don't forget that the Fed owns 2.2 trillion. So they're going to buy 200 billion. Didn't give a lot of information, and that sort of helped them in that moment. The lack of information after probably led some of it to kind of like bleed out and unwind a bit. But the Fed owns 2.2 trillion, and those are paying off. And that's approximately 180 billion a year. So then you start to think about, like, well, if the rate moves and mortgage prices go up, are some of the money managers just going to sell 100 billion over time, and do you kind of neutralize it? So I think it's helpful. It's indicative. Here's the real takeaway for us. Okay, so at that moment, it's how do we trade this? What's the price? What's the next step? But then we're really thinking from there, like, what does this mean? What's going to happen next? And sort of coming full circle, what it really does is show you how hard they're going to try to drive the mortgage rate down, to drive rates down overall, to sign up for an agenda and a plan to get rates down. Okay, so some of it is what do we do in that specific market, and some of it is how's it informing our view of the bigger picture.
So you guys have two, I don't want to say conflicting, but somewhat different risk factors you're juggling with. Obviously, when you buy paper, you're thinking long term, and we want to watch this play out to our broader thesis. But at the same time, you're actively trading on the short term. Mm-hmm. how much do these complement each other, or do you ever find yourself long in one duration of the portfolio and short in another? How do you balance this out?
Yeah, I mean, we have longs and shorts across the book within mortgages, within credit. We're long what we like and short what we don't, to keep it super simple, or long what helps contribute to our thesis, or protect, and vice versa, and protect the convexity profile that we're looking to achieve. We trade every day. We are active in these markets. It's part of more of a sort of a medium-term thought process, how they're going to play out. But every day is iterating on that. Is this still what we think? Are we positioned with the best version of it? Do we have the bonds that are going to contribute to what we are trying to achieve? Like right now, we're very focused on the flywheels that exist within financing markets. And if you think about, what does that mean? Okay, so rates come lower. Rates go lower. We talked about that a little bit. But credit spreads are also really tightening. And when rates are lower and credit spreads are tighter, your cost of borrowing has gone down. Means you can refinance all sorts of assets. It means some assets are even, at that point in time, worth more, valued highly. Now that it's worth more, you've got a lower LTV loan that you could take out an even tighter credit spread on. And how do these spin? And what is it? So this is very much what we're thinking about now. I think the market completely underestimates the power of those flywheels and what it can be achieved. So we look at our portfolio and say we want to have about 20 trades in it. And a trade is not one line item. A trade could be 30 line items. But the flywheel is a trade. It's a little bit of maybe even a bigger, higher order one. But we look at what is happening at that moment. Is there something to take advantage of? But also, what are the ripple effects of what's happening in that moment? And what does the market need to do? What is it going to do? Does it understand this? And then we unpack it and say, like, where's the opportunity? So coming back to what we talked about, we believe when you look at the world through this lens, we look at markets through the Marek lens, that the lack of connections made through these markets and the lack of extracting from some pretty obvious pockets are an opportunity. And I would, like we talked about, to improve your return and reduce your risk. And it's a process. So it's just as much a process in a machine through which you're extracting alpha from the market. We have our views. We hope to be right. It's a process through which you work through these markets that you extract all the time. And the mandate is pretty clear. Like, as I think of it, the mandate's very clear. You need to make money when markets go up. And you need to make money when markets go down. Every day, every month, every quarter, every year. And you probably won't, but that's the mandate. That's what you're going for. And it's quite simple when you frame it out that way.
You mentioned in 2019 there was a sea change in how you perceived what was happening in the market and how different that had become. How does that affect how you look at and define risk? Risk definitions have obviously changed over your career, but 2019 was such a sea change. What's different about managing risk today?
Yeah, I believe managing risk at scale is a skill. Okay? You have your numbers and you want to know what those are. And those are indicators and those are starting places. VAR is a number and a starting place and an indicator. Stress is a number. DVO1, CSO1. I like to look at the world in a stress-based framework, and we create a bunch of different stresses. Some are quite simple. Rates go up, rates go down. Credit crunch, a flight to quality. Some, we had our little, we're getting a little punch drunk. We have one we call QE for ever and ever. And looking at these, it's really about, it's a starting place for a conversation. Okay, because you do need to know where it's coming from and what's the attribution. What's the return attribution? Where are you hoping it comes from? And what's the risk attribution? And very importantly, what could go wrong? Understanding that, what you're trying to achieve, but knowing where the exits are. I think it's really like a philosophy to risk and to managing risk, to make sure you're pointed to achieve your goals while managing your risk properly and knowing what you would do if things changed, right? You have a plan and then things change.
Really, really interesting. When you're looking out at a variety of different opportunities, what do you think today presents the best risk opportunity? You're looking at structured credit, corporates, relative value. What is really drawing your attention?
Yeah, we've really thought that one of the places to extract from the flywheel is in securitized markets. Actually, as an example, like we've been very focused on trophy quality office in gateway cities, and this goes back a little ways.
These are the super A residential, commercial real estate office.
Right. So that all came to be from us pulling at the thread of how the financial system works. We talked a little bit about the new GSIBs. And what you had was everybody was going back to work, back to the office, but it took longer than looking back on it, that took a long time. The part of the financial system that was changing were those new GSIBs, Apollo, Ares, KKR, Blackstone, BlackRock. And they were coming back to the office and they were growing and they were finding that two things. One, they needed nice offices to kind of, get everybody where they want them to be, but also they were growing. And they outgrew what they had. And then they went looking for more. And what they found was there's actually not that much trophy real estate out there. And so like our view on the evolving financial system led us to have very strong conviction about a supply-demand imbalance in commercial real estate when applied correctly. And then we just looked for what's the best place. And it's tightened a lot. But actually, we think it continues to and has been because it's continued to be 1 to 2 steps behind the fundamentals. So what that really means, the way we think of it, to wrap it up in a nutshell, this is a BBB bond that we think is a AA.
Really, really, because everybody's painting with a broad brush of, hey, forget Bs, even A buildings are 60% occupied in terms of
staff. But they're not.
Staff.
They're 100% occupied with the waiting list.
in terms of staff returning to office. So it's fully leased, but the, Castle key cards are running 60% of pre-pandemic levels in a lot of cities. But the A+, the bigger shops, the JPMorgans, they want everybody back in the office, as does Goldman Sachs, as does a lot of these places, and they're all in trophy properties.
And it's not just New York, it's Miami, it's actually San Fran has come a long way. There are certain buildings there that we like. We actually, I would say a little bit out of consensus, we like DC, certain not the government buildings, but nice offices. Like we said, this is an administration that's in the business of being in business, which means you got to go see them and make your case. You want to get some business done, which means you need lawyers with a nice conference room that need a decent office, and et cetera, et cetera. I mean, like it sounds a little glib, but it's true.
It's the cost of doing business.
It's true.
Yeah,
and
absolutely.
So you can see there are certain companies that are buying buildings, knocking them down in DC and building brand new ones. And there are buildings that are being taken offline to convert to resi. By the way, everything we wrapped up in what we said, the conversion from office resi is actually spinning faster now. In DC, some buildings are being, and just outside DC, some buildings are being converted to data centers. So actually like stock's being removed all the time. Anyways, it's just an example of how like we're pulling on threads and we're finding where we can best take advantage of it and like what are the next couple steps. And ultimately, we're looking for what's something that's already gotten better except the price hasn't changed yet.
That's really interesting. You've mentioned stress scenarios a couple of times. We know that correlations have a tendency to go to 1 and liquidity disappears.
Well, I think I've seen that personally, right?
Enough
Liquidity
times over your
disappears.
career. Yeah.
I think I would just wrap that up. I make 2 comments to people. I say, like, 1, you don't go out of business because of your assets. You go out of business because of your liabilities. And when you start looking at that side of the balance sheet first, then you understand things a little bit better. And then also, with my traders and all the people I work for, it's really great because some of the people I hired a long time ago, they're MDs at places. Now I actually take a lot of pride in the people I've worked with who have gone on and done fantastic things. I really, really hate the phrase money good. Okay, I don't think anybody should be allowed to say it. It is this like false crutch. I also, in many, many conversations have said to people, yeah, I think you're right. In fact, you've convinced me. I believe you are right. I'm just letting you know you're going to get fired long before we know the answer to this question. Okay, let's take everything we thought, everything we've known, and let's put it into the context of how do we apply this in markets? What's going to happen? What's everybody else doing? And how do we take advantage of that?
Really, really fascinating. Last question before I get to my favorite questions. What do you think investors?
I thought those were your favorite questions.
Oh no, you'll
okay.
You'll see the favorite questions.
All right.
What do you think investors in the credit and alt space are not talking about, but perhaps should be? What topics, assets, geographies, data points are getting overlooked, but really shouldn't? Yeah,
so it's a great question. We touched on it a little bit. They're underestimating the power of this flywheel. Like with the background I've had, and we've talked about, and I've seen a lot of things blow up. Like we could come up with a lot of examples of things that could go wrong. I think they're underestimating the things that could go right, or what the power of financing and the mechanics around financing and the provision of liquidity and credit spreads, when they're good and when they're tight and when the machine is flowing, what that financial engineering can really do to both recover value and create value. I think they're underestimating it. The other quick thing is, in the middle of the year, if Kevin Warsh ends up sitting in that seat, and if we get a little bit of the setup that he's looking for, he's going to change everything, right? So he believes we're going to have a big productivity dividend from AI, and we're going to have a big productivity dividend from deregulation. And then that would allow you to have lower rates and a smaller Fed balance sheet at the same time. And if he gets a little bit of what he needs to craft that argument, we're going to have a very different second half of 26 than the first half.
Really, really interesting. All right, let's jump to our favorite questions, our speed round. We'll get you guys out of here at a reasonable time. Starting with, who are your mentors who helped shape your career?
Oh, I've worked for some pretty amazing people, and I tried to learn from everyone. I just had the bosses that I've had are legends in this industry, whether it's Bruce Richards, T.M. Perlow, Jimmy DeMar, Matt Zeems, Daniel Pinto. I mean, these are people who defined these markets, and they all had a huge impact on my career.
Really interesting. Let's talk about books. What are you reading now? What are some of your favorites?
Oh, but like I am in front of a computer screen and reading so much, and I read so much analytics, research, et cetera. When I get home, it's a little bit more like hang out with my wife and kids and a little TV.
Well, that's my next question. What are you listening to or streaming? Give us your favorite Netflix, Amazon Prime, whatever.
I will watch pretty much anything Taylor Sheridan, like the
we
whole
just finished
Paramount
season
Plus
2 of Landman. It's so good.
Like Landman, all the Yellowstones, everyone, 1823, 1920, all of those, Lioness, any of those. I'm a sucker
Lioness was also great. There should be a new season of that coming out one of these days.
Yeah, there is. I mean, I think I've watched both seasons like 100 times.
Final 2 questions. What sort of advice would you give to a college grad interested in a career in investing, credit, trading, what have you?
I just think it's not, it doesn't have to be a commitment for life. Just look at it as what's something I'm interested in being interested in. I think you can pick the kind of people you work with, and you want to be around good people who will teach you, who will support what you're doing, and just say, I'm going to give this a spin for 3 to 5 years. And if I like it, I love it, maybe I'll sign up for another 5. But, you have an opportunity to try something out and see if it's for you.
And our final question, what do you know about the world of trading credit, investing in alternative sources of liquidity and other products that would have been helpful 25 or so years ago when you were just getting your legs under you?
I wish I knew a fraction of what we are applying at Marek any point before we did this. If I knew a drop of what we're doing when I sat in other seats, yeah, I'll put that all in the I wish I knew bucket.
Really, really absolutely fascinating. Matt, thank you for being so generous.
Thanks for having me.
With your time. We have been speaking with Matt Cherwin. He's co-founder and chief investment officer of Marek Capital. If you enjoy this conversation, well, be sure and check out any of the previous 600 or so we've done over the past 12 years. You can find those at iTunes, Spotify, Bloomberg, YouTube, wherever you get your favorite podcasts. I would be remiss if I didn't thank the crack team that helps us put these conversations together each week. Alexis Noriega is my video producer. Sean Russo is my researcher. Anna Luke is my podcast producer. I'm Barry Ritholtz. You've been listening to Masters in Business on Bloomberg Radio.